Welcome to The Bell, a spirited conversation for thoughtful investors. I'm Adam Johnson in New York, Tom Esses in Florida. Okay, Tom, we're back to school, back to work, and back to volatility. How you doing down there in Florida?
I'm doing well, Adam, and I'm happy to be back. Down here in Florida, we definitely have a feeling of fall in the air. The temperature has broken 90 finally. Which is a welcome relief.
Tell you what, we got a lot of motion today. We got a big show, an outstanding guest. We're joined by Frederick, who is Vice President of Trading and Derivatives at Charles Schwab. We're going to get to him in just a minute, but let's start off with the order book, because there are three things you and I got to work through. Number one, forget the Fed. Focus on Japan. Number two, what REITs really stand for, real estate investment traps. I will explain why. And Morgan Stanley says, sorry, guys, the data sucks. Sorry about that. So I tell you what, forget the Fed. You say focus on Japan. Explain why, Tom.
If the Bank of Japan does not ease further, you're going to see U.S. Treasury yields continue to rise. And it all has to do with money flows. Too many Japanese and European investors have bought treasuries. If all of a sudden yields in those countries keep going up, which they have been going up basically since July, you're going to see treasury yields keep going up. That's going to be a problem for stocks. Watch the Bank of Japan. It's more important than the Fed next week.
Wow, that's interesting. So what you're basically saying, because you have negative rates in Europe and Japan, those investors have come to U.S. Treasuries. That's why policies by those two banks mean more right now than the Fed. Number two, real estate investment trusts or traps, and I'm going with traps. And here's why. If, in fact, you have rates rising, that means borrowing costs for REITs are going up. That's not good. You have a lot of real estate here in New York, and by the way, I'm no real estate developer, but I've just interviewed a number of them who've effectively told me that these projects have been financed at 3 to 4% cap rates, which means that you have to have full occupancy for 25 or 30 years just to get your money back as a developer. That doesn't work. We've bid up the price of real estate too high. And then finally, look, retailers are going online. So 8.7% of retail sales now are actually online, which means, you don't need malls necessarily to the extent that you used to. Three reasons not to like real estate investment trusts or traps, if you will, Tom.
Absolutely. I couldn't agree with you more. We're seeing that locally here down in Florida. A lot of the malls, these are super high-end malls that have very, very luxury stores in them. They're starting to go empty, which is almost astonishing. And people are not shopping in the malls anymore. I mean, this is going to be something we're going to look back in 10 years and say, wow, that was a secular change in the way consumers behave.
Morgan Stanley, the data sucks. Okay, they didn't actually say that. But that's what they're saying. Yeah, they are literally talking about the top of the cycle. They say if you look at Purchasing Managers Index and multi-year lows, soft job report, leading economic indicators, this economy has a problem. Again, according to Morgan Stanley, they say the expansion is over. This has been the shallowest recovery in 30 years, and they don't like it.
And especially in August so far, they have a reason not to. Now August has to be taken with a grain of salt because it seems like August data always seems to disappoint, and that's especially true in the jobs number. And again, we saw that in the August jobs number just a few weeks ago. The big thing that caught my eye, though, was the PMIs, these manufacturing and non-manufacturing PMIs. The manufacturing PMI for August dropped below 50 for the first time since February, which just shouldn't be happening.
Yeah, that means contraction, right?
Yep. That means the space is actually contracting. Now, the non-manufacturing PMI, which is just a fancy name, it's service sector, and that's by far the larger portion of the U.S. economy, even though the number isn't as publicized. That dropped to the lowest level since February of 2010. That shouldn't be happening right now. Sure, there can be anomalies, but you're not seeing anything like that in the other data.
All right, time to bring in a pro. Someone who has been dealing with these markets for years, is followed by thousands of investors around the world. We're talking about Randy Frederick, Vice President of Trading and Derivatives at Charles Schwab. Hey, Randy, thanks for joining us today.
You're welcome, Adam. It's great to be with you.
I should note for our listeners, you are joining us from Austin, Texas. Hey, before we get your take on markets, how did you put that deal together with Charles Schwab where you said, yeah, I can run trading from Austin, Texas?
Well, it's interesting. It happened a long time ago. I moved here about 17 years ago. Schwab acquired a little small day trading shop by the name of Cyber Trader, and I had an opportunity to come down here and sort of build out a derivatives business. So that's how I ended up here. And frankly, I'm happy here and hope I don't have to leave.
Volatility is back. What is happening in this market? Give us your perspective from where you sit at Charles Schwab.
Well, you're right. I mean, we had almost 6 straight weeks of unusually low volatility from about mid-July until just a few sessions ago, or middle of last week. But this is, I think, an important point, and I regularly remind people that I speak to, our traders and our investors, that high volatility usually means that you get big moves in both directions, and frankly, that's exactly what we have.
Oh, that's a good point. It's not just one way or the other. Tom, you've written a lot about that.
Yeah, absolutely. I mean, the doldrums in the summer were really sort of astonishing, and most of our client base is financial advisors, so we have sort of an interesting pulse on what they're seeing as well. And it's almost like everybody took the summer off, including the markets. But now we are definitely back to volatility, and there are a lot of important events coming up. One of the things that people are not talking about a ton, Randy, that I'm sure you have an opinion on is the election. I mean, we're so focused on central banks right now, it's like almost like everybody in the market to a point is ignoring what's going on in politics. But we got a critical election coming up. What are you seeing there and potential market impact?
The market doesn't really pay a lot of attention to them until they get pretty close to happening. In other words, why worry about the election that's happening in November when it's August or September? By mid-October, sure, the markets will be focused on the election, but this one is just kind of a circus, and I think forecasting the market's reaction to the election is very, very difficult given the lack of any comparison. There just isn't any. I mean, you have to go back to when we were all kids to see that.
Can you wrap some numbers around the presidential cycle and historically, Randy, what we have seen during election years?
Yeah, it's a fascinating topic to dig into, and I've looked at it in a number of different ways. There are a lot of data you can look at. The ones that I've been focusing on here lately that I've mentioned to our clients in some of my commentary, which I think is pretty fascinating, is that if you remove the 2 most recent bear market elections, which we know happened in 2008 when Obama was first elected right in the midst of the financial crisis, and then back in 2000 right as the internet bubble was falling apart. If you take those 2 bear markets out, all of the other elections since 1988, the S&P 500 has done extremely well during this period of the year between about September 1st and Election Day. In fact, the average is about 4%. Even more compelling, I think, is if you exclude, again, those 2 years of 2000 and 2008, you can go all the way back to the post-World War II era of about 1950, and the S&P 500 has averaged about 4.7% from September 1st through year end. So this period of time in an election year, when we're in a bull market, which we clearly are, has actually been quite good. A 4.7% return from here on out when we're up 6% or so, I think most people would be pretty happy with that.
That's a good year. Considering the last couple, that'd be a good year for everybody, definitely.
How is that information shaping your own view on the market, what you're telling Schwab clients, and then obviously the strategy that goes along with that? Well,
the strategy that I've been focusing mostly on, and I've written an article on this, and I've been pointing a lot of people to it recently, is how to hedge these unknown events. Because despite providing all this data, we still have the big unknowns. We don't really have good comparison. We don't have previous elections that are the same as this to compare to. So I've been focusing a lot on telling people about how to use equity collars. It's a very simple strategy. I'm sure both of you are well familiar with it.
You're effectively buying a put and funding that purchase with the sale of a call. So that would be a no-cost collar, and that way you're protecting yourself without giving up all your upside, right?
That's exactly right. And it can either be done at no cost or at a very low cost, sometimes even at a very small credit. It ultimately depends on where the stock price falls between the available strikes. But nowadays, most actively traded stocks have a lot of strike prices and a lot of different expirations, and you can almost always construct one somehow that gets you very close to almost no cost at all, which I think is really useful.
That sounds like a very good strategy, and I think it's a super value add to investors and traders that aren't thinking about that. Using these strategies like a collar in this environment definitely can make a difference.
Randy, you have run a number of trading businesses, and of course now you're running Charles Schwab, one of the largest. What are some of the mistakes that even the pros make?
If there's any piece of advice I think I could ever give an investor, it's know what you're getting into before you put your hard-earned money in it so you don't lose money. My second answer is basically this. Quit wasting all your time and all your money trying to prepare for that next big black swan event, that big spike in volatility that's going to occur. They happen so infrequently, and they're impossible to predict.
I used to work on the floor of the New York Stock Exchange. I started my career there, and I was lucky to work. Art Cashin's son, who everybody knows from CNBC, Peter, was my broker, and I used to chat a lot with Art because of that, which was a neat thing for a young kid just starting my career. And he used to always say, "Kid, remember, betting on the end of the world is a bad bet. You can only be right once."
That's exactly right. That's probably a great way to sum that up.
I love it. Hey, guys, I think time for the 3 L's. What have we learned? What are we looking forward to? And what do we love? I'm going to start us off. What have we learned? Silence is golden. A golden opportunity, that is, to buy puts. In other words, when the markets are silent and quiet, as they were in August, you buy puts. When things get too quiet, you just got to pay attention, which is part of the point here. What am I looking forward to? Thursday night, of course, Jets versus Rex the X, playing the Bills up in Buffalo. Rex Ryan left New York City, thank God, and we are free of him. We got a new coach. I want a victory on the road. That's what I'm looking forward to tomorrow night. And what do we love? I wrote up Cheniere in the upcoming Bullseye Brief, which is the only U.S. LNG export terminal. It's a fascinating play. Guys like Carl Icahn are long this stock because the natural gas that they sell out 20 years is indexed to the forward price of crude. So it's really not a gas export play. It's actually a call on crude oil. I love it. It's a fascinating story. I'm writing it up in Bullseye Brief. So those are my 3 L's. Randy, what do you have for us?
Well, I'm going to go back to some of the things we've talked about already. What I've learned is, or what I think we've learned is to expect more volatility in the near term. The quiet period is pretty much over. There are a number of events on the calendar between now and year end that are going to cause more volatility. But more importantly, we know what the potential volatility inducing events are. They're on the calendar, they're specific dates, and we know how to deal with them. What we're looking forward to, this might sound strange. I am looking forward to the Fed raising another 25 bips on the discount rate. And the reason I say that is because I'd like the market to stop obsessing over it so we can focus on more important things like GDP growth, like earnings growth, like really, I mean, I hate to say it, but the election. I'd like to get this out of the way because the market has been obsessed with this for now 9 solid months. And if we don't get a rate hike next week, 3 more, it's going to be a whole year. So I would love to just get that done and off the table and out of the way. And then what I love is, again, the strategy we just talked about, equity collars. I think they're brilliant. I think they are. How many strategies do you have that don't cost anything that you can put on whether the volatility is low, medium, or high? Then it doesn't really affect it all that much, and can be put on to target a specific item on the calendar at a specific time. And ultimately, the worst case possible scenario here is what you think could potentially be a bad news event ends up being a good news event, and the market skyrockets and you miss out. That's just not going to happen very often. And if it does, it's not going to happen in a day. And if you set these things up so they expire within a couple of days after the event, the potential loss opportunity is insignificant relative to the potential risk of not being hedged when those things occur.
Tom?
I have learned that over the next week, the Fed is the third most important central bank for U.S. stocks, and it goes to Randy's point. It's much more important what's happening with global bond yields. If global bond yields keep rising, that's going to be a problem for stocks. What am I looking forward to? I'm looking forward to the first presidential debate. I know it's about 2 weeks away, but I mean,
everybody is.
Talk about Circus Maximus. God only knows what's going to happen when they get on that stage. And then what do I love? European corporate bonds. This is a bit obscure, but there are mutual funds that people can look at that get exposure here. There is ECB QE buys European corporate bonds. Because of the cost of hedging for foreign portfolio managers trying to buy U.S. treasuries, it doesn't make sense anymore. That makes domestic, i.e. European corporate bonds, more attractive. It's not a yield play. It's a principal play. The ECB needs to buy these things. European investors need to buy these things. Check out some mutual funds that have some European corporate bond exposure.
Tremendous content. Randy, you put a lot of content out to Schwab customers, but I know that even non-Schwab customers can still read some of your insights. What's the website they should go to? You
can find most of the content that I and my team put together at schwab.com/Randy Frederick. That's probably the easiest way to get it. Or just go to the Schwab website, type in my name, you'll find it there as well. We put out a daily blog that comes out every afternoon that highlights all of the big activity, block trades, huge spreads. And then I put a very comprehensive report out on Friday afternoons that covers the whole week of what happened and what to look for the following week. Those can both be found on our website with a little searching.
Love it. And Tom, your website?
www.sevensreport.com. Everything you need to know about the markets by 7 a.m. each morning in 7 minutes or less. Just go on there, and there's a free 2-week trial for anybody interested. Just give us your email address, and we'll add you to the rolls for 2 weeks.
And I am, of course, Adam Johnson at Bullseye Brief. Guys, thank you. Randy, thank you so much. What a pleasure to have you on the podcast today.
Randy, thank you very much. It was fantastic.
Thank you, Tom and Adam. Yes, thank you.
All right, guys. Have a good, safe trading day, and we'll be in touch.